Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Sébastien Page joins us. He's the CIO and head of global multi-asset investing at Rowe Price. Great thing about Rowe Price down in Baltimore is they do everything. There's stocks, there's bonds, there's commodities, private markets. So they see pretty much everything. Any deal flow that crosses globally, Rowe Price gets a look at it. So it's a good opportunity to get some thoughts there. Sébastien, thanks so much for joining us here. You see the geopolitical risk here that we've all been dealing with over the last several days. I know the smart folks down at Rowe have been chatting about what to do here. How do you guys think about positioning? What's the messaging to your clients these days?
Well, Paul, as you might expect, our research platform went into overdrive over the weekend. I'm catching up on all the analyst notes. We have 300 research analysts. They cover every stock in the world that's of a significant size and every sector and every market. And we have asset allocators and economists and macro researchers. And I'll say this, there is no real base case right now. I know it's probably statistically incorrect to say, but it really is a matter of scenarios. Our analysts are debating this in terms of a short war or a longer or protracted war with certain probabilities. One analyst went as high as 50% at some point over the weekend that we see Brent above $100. So it's a tension between these two. On the short war scenario, well, you just reported apparently Iran reached out, but also a Wall Street Journal reported that Iran shooting missiles and drones at the Gulf countries and the Gulf countries defending, they're both running out of missiles and drones and defense systems. So the Wall Street Journal described it as a race. So what do you do, Paul? Because this is something I hate to say, which is the range of outcomes is wide because it always sounds like an out. But right now, really, you have these, I call it a bimodal distribution. I know Tom's not here today. He would probably want to talk about the bimodal distribution, but we're talking about two events and you can't really average them into a base case. So you hedge, and our strategy in our portfolio has been to be long real asset equities, and we've been long real asset equities for a while.
What is real asset equities in your mind?
Yeah, in our case, it's a diversified portfolio of stocks. Of course, it includes energy companies, but also metals and mining and precious metals, which have been doing really well, and real estate, too. So we define this as a strategy or an asset class, and then it's in a stock portfolio. You can put a sleeve in there, like 10%. One of the risks when you get inflation shocks or oil price shocks, Paul, is that bonds, like treasuries, don't act as the hedge as well as they do when you get a pure growth shock.
So I'm curious, you mentioned real estate is one of the real asset equities that you pay attention to. Talk to me about what areas of real estate are attractive to you.
Well, it's a broadly diversified portfolio. Again, I just said the range of outcome is wide, and now I'm giving you another term I don't like to use. It's across all real estate markets, so residential and commercial and so on. And it's part of a diversified real asset strategy. It doesn't move hand in hand with energy prices, and that's a feature, not a bug, right? So we like putting all these stocks together and have it as a dedicated allocation. Because if you compare this with commodities, for example, with the real asset equities, you get an equity risk premium over time. So even when there's no geopolitical risk, you get pretty good equity returns. And then when you do get an inflation shock and bonds like treasuries go down together with stocks, those stocks actually behave quite well and can outperform significantly in the portfolio. And it just comes down to having a range of outcomes here. The bear case is that this could go on for a while. Another word I hate to use is unprecedented, but the way the Gulf countries have been engaged and attacked here and the way this is going, and President Trump was saying it could be 4 or 5 weeks. It'll take as long as it takes. This could go on. we have analysts that have done a study of oil price shocks, and they calculated with many years of data that after the beginning of the military action, on average, oil continues to rally to a peak for 23 days, and that the average oil rally is 27%. Again, this is not a really direct comparable to historical military actions, but this just gives you an idea that oil probably hasn't peaked yet.
So I understand that you have a diversified portfolio, but how exactly do you position yourself for that worst case scenario, the bear case scenario? Where do you find a safe haven?
Yeah, so if you look at how we're positioned right now in, for example, our equity portfolios, some of the sectors our portfolio managers like are healthcare, as well as technology, which is interesting. So healthcare, more defensive technology, materials, energy. So these are the types of long positions we have across our portfolios when our portfolio managers actually select stocks. I look at asset allocation from the top down, but I like to see where they're positioned as well. So it's kind of a barbell between tech and, the AI theme. You don't want to be completely underexposed. And then things like energy and material and healthcare. So the combination of those two overweights would say maybe underweight consumer discretionary or underweight the core equities that are very expensive but not AI exposed or not AI beneficiaries, could be AI victims. You kind of underweight that, and then you go to the wings. It's, in a sense, it's in large cap, it's overweighting growth and overweighting value, and then underweighting the core. So broadly, this gives you an idea of how we're positioned. In terms of multi-asset hedging in portfolios, treasuries still have a role if you expect some growth shock, which could come, right? If you get a spike in oil prices, gasoline prices go up, the consumer, it's like a tax for them, for the consumer, and then you get a drop in growth and earnings come down. So treasuries have a role as a hedging. It's just not the end-all, be-all hedge. Commodities can help, gold can help, cash can help, and then real asset equities. So we like to diversify our hedges because, especially, and again, I hate to say it, but I'll say it twice, the range of outcome is pretty wide right now.
Sébastien, just real quick here, 30 seconds. The AI trade, that was really under pressure before all this geopolitical issues hit. Where's T. Rowe stand on kind of how to play the AI story these days?
We're playing it selectively, and we see industry being hit one by one. We're generally bullish on AI and the efficiency it will bring, but it comes down to focusing on those that will benefit from AI, anticipating disruption. And Paul, I'll end my 30 seconds on that. This is why we have 300 research analysts and I would say one of the top 5 research platforms. Thank you for allowing me to give that plug.
Oh, I know. They were my client. I took the train down to Baltimore many times a year when I was on this sell side here. So, Sébastien, I mean, again, uncertain times here, unprecedented times here. Do you think about U.S. versus non-U.S.? Does that change here at all here, given some of the geopolitical risks out there?
Well, yeah, and I should have mentioned the dollar is still a hedge generally,
Yep.
and we're kind of seeing it hold up here. So we remain long in our asset allocation portfolio, non-U.S. equities, because you do have a clear valuation advantage, which typically is not enough, but also catalyst for broadening of global growth and more spending in Europe and so on. So we remain overweight international equities, especially international value stocks, industrials, financials, and so on outside the U.S. But longer term, we believe that the U.S. will remain a strong engine. So again, I'm giving a kind of half full, half empty answer, but it's short-term tactical, long international, long-term still bullish on the U.S.
So on a typical week, I'd imagine we'd be talking a lot more about the Fed. I'm curious, the economic data is still in the background. How are you thinking about the economic environment and how that actually influences how you position?
I think the biggest risk right now is that inflation surprises on the upside. And commodities are so unpredictable. As asset allocators, we have to be humble. And I like to say it's the hardest to predict asset class. And we see it here with supply disruptions that can be quite unpredictable. So that is a risk because the Fed wants to cut and the base case remains that the Fed will cut and that will be stimulative. But if we get an inflation shock, that could make markets quite nervous.
Yep. Sébastien, thank you so much, as always, for a few minutes of your time. Sébastien Page, he's the CIO and head of global multi-asset at T. Rowe Price.
Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So the markets are trying to digest the geopolitical news and react in terms of how this affects valuations for stocks, bonds, commodities, real assets, including the Treasury market as well, particularly on the short end of the curve. Debbie Cunningham is the expert on the short end of the curve. She's the CIO of Global Liquidity Markets for Federated Hermes. Debbie, what's your view when we kind of go into these black swan type of events here, the level of uncertainty in the markets? How do you see that reflected in your short-term Treasury money markets?
You know, in the U.S., it really generally what we see for our Treasury security funds, the funds that are only buying U.S. Treasury securities, repo backed by U.S. Treasury securities, is a flight to quality, where number one, a lot of cash flow comes in, and number two, prices go up and yields go down, and a flight to quality sort of trade. And we haven't seen that quite as much. We've seen a little of it, but not as much as we generally do. I think to some degree, it's because of the inflationary concerns that this particular black swan event has as far as potential implications from a market perspective goes going forward. So a little bit less of that than what we're used to seeing. But on the other hand, on the good side of that equation is the non-treasury market. So, commercial paper, CDs, those that are not backed by the U.S. government, don't seem to be seeing a whole lot of spread widening, maybe a basis point or two, but nothing out of the ordinary in the context of market volatility on a day-to-day basis. I will say our London liquidity operations seem to have a little tentative nature to them, little less two-way flow than what we've been seeing here in the U.S.
Mm-hmm. Debbie, so where do you go? I mean, we've been talking so much about uncertainty. I know in your notes you talk about the Fed's future. Of course, the economy in focus, geopolitics. Where do you want to be right now in the short term?
Well, from a short-term perspective, we are still very comfortable being, long duration, long weighted average maturity. I would have said probably less than 2 weeks ago that we certainly think the Fed's next move is either to stay on hold or to go lower with rates by 25 basis points, maybe 50 basis points this year. But with this new situation, maybe it stay on hold, or you could go in either direction. Maybe 25 basis points higher, 25 basis points lower. Growth in the U.S. continues to be pretty robust from a retail perspective. And if inflation starts to, rear its ugly head again, you could potentially see a move by the Fed that goes in the opposite direction. But at this point, the yield curve is reflecting enough from a steepness and a value standpoint that we're still pretty comfortable being a little bit longer duration.
What's longer duration for you, Debbie? I mean, is that a couple of weeks? I mean, talk to us about how you view duration in your market.
Yes, it is a couple of weeks. So depending upon what products we're talking about, if they're talking about money market funds, their max duration is 60 days. So the difference between 55 and 55 is huge. Now, if you're talking about micro short funds, there you have a little bit more leeway. 180 days is kind of like your average. So we're north of that. We're over 200 days. Similarly, with our ultra short type of products, where generally it's more like an average 1 year duration. Again, a little bit longer, a little bit shorter is a couple weeks to a couple months. But depending upon what is being offered in the marketplace, sometimes it really does very much help.
Debbie, where do you not want to be right now?
I think we probably don't want to be extending credit at this point. So we do a lot of global finance. Yes, we finance, companies, banks here in the United States, but we do that globally across, the G7 countries. And ultimately, we have duration limits on the issuers and on the countries themselves. And oftentimes our credit analysts have the leeway to maybe extend those limits a little bit. If the trader sees something that they find extremely valuable, they'll have a discussion, maybe make a few exceptions to those limits. That's not what we're doing right now. Right now we're holding pat, and if anything, narrowing those limits a little bit more.
Debbie, just about a year ago, we started, dealing with tariffs and what that would mean to the global economy. And we saw a lot of capital leave the U.S. and sell the U.S. and maybe redeploy in other parts of the world, and most notably in Europe. Did you see that in the short-term part of the Treasury market? Did you see money leaving the U.S.? And if so, is it come back? Or how do you think about the U.S. versus rest of the world?
We did not see that. I mean, if you look at, the money market industry itself as kind of a measure of that, went from 7 trillion to 8 trillion last year. The bulk of which is in government treasury types of money market funds. Having said that, other parts of the world that we operate in the European market, we crossed 1 trillion from an industry asset standpoint in money market funds. So I feel like the flight to quality is still in the short end, the front end of the curve. And it's a safe haven for those who are looking to kind of, take cover for a little bit while other situations play out. And whether you're operating in the U.S. and, Europe, in Asia, all of that continues to sort of play through without too much effort. I mean, certainly I would think that Treasury Secretary Bessent would not be complaining about the financing that is being received from a U.S. government and Treasury bill perspective.
Well, there's a lot to keep your eye on right now if you are a trader in this market. But what is the most underappreciated macro risk that you see right now?
Well, I think it's the unknown. Honestly, I guess the Middle East and Iran was a brewing situation. So it was something that you wouldn't necessarily consider an unknown. But, there's other situations that, come about where you're just blindsided to some degree. And so I think making sure, you're comfortable with the firms, the companies that you're financing, from a debt perspective, and you're comfortable with that in a positive situation globally, and you're comfortable with them in, a neutral to negative type of situation. I think the other thing we like to try to do is finance firms that are necessary items, whether you're with necessary, produce necessary items or necessary, types of services, no matter whether the economy is booming or whether the economy is pulling back and retracting and people are staying home and not buying. And that's also, I think, a very helpful tactic at this point.
All right, Debbie, thank you so much. Always appreciate chatting with you. Debbie Cunningham, CIO, Global Liquidity Markets for Federated Hermes. When the Fed, I think, wants to raise some short-term paper, they just pick up the phone and call Pittsburgh and talk to Debbie and see what's going on there. So she is one of the absolute leading voices on the short-term money market business.
Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Tell you one job I wouldn't want to have right now is Global Market Strategist. With all the headwinds, crosswinds, what's going on, geopolitics, I don't know what you do. Our next guest, she has that job. Meera Pandit, Global Market Strategist for JPMorgan Asset Management. Meera, the last few days kind of just resurrected the geopolitical risk that had been a little bit dormant. Yes, we have issues in Ukraine and the Middle East and Venezuela and so on and so forth. But boy, this came right back into the front burner. How are you guys thinking about the economic impacts? People are talking about inflation, maybe stagflation. How are you guys thinking about it?
For us, it's more inflationary than stagflationary. From a growth perspective, the U.S. has the advantage of being a net exporter of energy, and that is an advantage that Europe doesn't have, and that's why I think you see some differentiation between different global markets, not just the U.S. and Europe, but also the U.S. and Asia. So that is one help when we think about the overall economic growth landscape. I'd also point to the fact that it's coming at a time where we also have consumers receiving elevated tax refund checks, which does help buffer some of the potential rise in overall gas prices at the pump. And right now, oil prices are still relatively well contained, considering what is unfolding in front of our eyes and considering some of the challenges in the Strait of Hormuz right now. So given that, we may not see all that much of an impact to growth. But similarly, we may not see a huge impact to inflation. That's probably where we're going to see the biggest impact overall. But overall, it's not going to tip the scales to a spike in inflation. This is not 2022. I think that overall, the trends underneath the surface are still relatively disinflationary. That headline number might be disrupted for a small period of time. But as it was, we were expecting this year that inflation would peak above 3% at the midpoint of the year because you still have ongoing tariff challenges, because you also have those elevated tax refunds potentially driving up demand and therefore prices. So it doesn't change our view. It reinforces it a little bit and maybe emphasizes some of that upside on inflation in the short term.
So what risk stands out to you the most? I mean, we called out a bunch of things from tariffs to we can throw in AI disruption, of course, these geopolitical risks that are ramping up this week. Tell me what stands out to you as the biggest potential headwind.
The biggest headwind right now to me across the board is sentiment. Because ultimately, you're in an environment where the fundamentals haven't changed that much. Yes, there is this war unfolding in the Middle East, but we're not seeing that major pass-through of higher oil prices become unhinged. If we think about AI, underneath the surface, the fundamentals haven't changed. You're still seeing extraordinary profitability, double digits across the Mag 7, hyperscalers seeing cloud revenue growing 37% year over year. Valuations have actually gotten cheaper because of that sell-off so far this year. And the technology continues to innovate and get more powerful. And the narrative there has switched from, is AI a bubble? And therefore, are we overestimating AI to actually, is AI something we're underestimating? And there's this mass displacement. So the sentiment risks to me around AI, around geopolitics, around tariffs as well, where, there's still a lot of uncertainty around how tariffs will look. But we know that they're probably going to come in, perhaps a little bit lighter than they have in the past year. But nonetheless, they will still be a feature of this administration. And then you take a look at the broader backdrop where you have the easing bias from the Fed, the easing from the government when we think about fiscal and the elevated tax refunds, and the overall environment from a cyclical perspective is still generally supportive. So I think that's where you're seeing such a big tension between the fundamentals, which still look okay, relative to the sentiment, which people are just feeling so much anxiety in this market in so many different pillars.
Before the Iran news came up, we were seeing a rotation in the marketplace from growth to maybe value, small cap, that type of thing. How do you guys think about that?
We're continuing to see that. And I think part of it is a bit of a breather from areas like tech, but you're also seeing this rotation within AI from the tech innovators to the infrastructure layer, the beneficiaries of the overall capital spend. And that's why you're seeing that while tech is down about 5 or 6% year to date, 5 other sectors, not just energy, are up double digits. And that includes materials, industrials, a lot of those AI infrastructure layers.
Meera, thanks so much for joining us. Appreciate you sticking around. We had some of the news coming out of DC. Meera Pandit, global market strategist. She's got this stuff down. JPMorgan Asset Management. Appreciate getting a few minutes of her time here in our studio.
Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Angie Gildea joins us, energy sector leader for KPMG. Angie, what's your view here, the collective view of how these energy markets are reacting to this conflict in Iran?
Well, it's certainly a fluid situation that's changing sometimes hour by hour. But I think what the key concern is really is, as you mentioned, that Strait of Hormuz and how much of the oil supply can get through that strait. As you said, it's about 20 million barrels a day of our products. So that's something to really critically watch going forward.
So how big of a disruption are people expecting this could be to global supply?
Yeah, there's two parts that play into this. One is what the markets anticipates going to happen in terms of if this is a long-term or a short-term conflict. And the second is just the overall supply and demand dynamics. We were in a bit of an oversupply in the market, so there was some cushion there. But I think certainly as this continues to go forward, if it's resolved quickly, I think it's going to be a short-term lived bump in prices. If it's something that happens over a longer-term period, it's certainly something that's more problematic.
Angie, President Trump said the U.S. will ensure safe passage of oil from the Middle East, and that the U.S. will offer insurance to help ensure the flow of energy. Will that be helpful? And if so, to what degree do you think?
Well, I think it really just depends on how much of those tankers can get through. If the strait is open and the flows can flow pretty easily, then I think, supplies less disrupted.
So what buffers do we have? What are the alternative sources here?
Yeah, that's a great question. There's a little bit of a buffer in terms of an east-west pipeline that the Saudis have that run through the Red Sea, but that's only about 4 million barrels in capacity, so that's pretty limited. We do have the strategic reserves. The U.S. has roughly 20 to 25 days of strategic reserves. China has been stockpiling some of their reserves, so there's some buffer there. But in terms of other buffers, I've had a lot of questions around the U.S. shale industry. We don't really see that as a spare capacity at this point. It would need a couple of quarters for that to ramp up. And of course, we would see a Liverpool if that's more of a long-term issue for us.
And Angie, what are we hearing from some of the U.S. producers? Are they in fact thinking about ramping up production here? I mean, boy, with these prices, you would love to get more oil into the market, perhaps.
Yeah, it takes more than a couple of days to get the production ramped up. You've got to put the contracts in with the drilling companies. You've got to get people on board. So at this point, I think everyone's more of a wait and see. You don't want to ramp up something that if the prices are going to be short-term lived. We also have had a lot of consolidation in the market, in the industry recently. And so the smaller players that maybe typically would have rushed in and added to productions, those don't exist anymore. And it's more of the larger players, and their investors are telling them they want discipline reserves to shareholders. So I think it's more of a wait and see at this point. What we are seeing is companies putting hedging in place to try to lock in on some of these prices.
Interesting. How about OPEC? Have we heard anything from OPEC or OPEC Plus?
Yeah, OPEC, as you know, just said that they would release about 200,000 barrels of spare capacity. And so the majority of the spare capacity with OPEC sets with the Saudis and with the UAE. So there is some flex there. But again, if the strait's closed and you can't get that supply through and there's limited capacity in the pipeline, it doesn't really help that much.
So all these things considered, in the background, we also have this higher for longer rate environment. How are you thinking about that and potential demand destruction, potentially?
Yeah, prior to this conflict, we were actually looking at a bit of a challenging year from a oil producer standpoint, in that we had oversupply in the market. And so it was going to take a while for that to wind down. So I think at this point right now, again, if the conflict is relatively short-lived, then I would anticipate things would, stabilize and go back to normal. But if this plays out over several months or several quarters, we're looking at something entirely different.
All right, Angie, thank you so much. Appreciate getting your thoughts there. Angie Gildea, energy sector leader for KPMG down there in Houston, Texas.
Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Let's stick with geopolitics. We can do that with our next guest, Liana Fix, Senior Europe Fellow on the Council of Foreign Relations. Liana, thank you so much for joining us here. I'd love to get your thoughts on is there any consensus from our friends in Europe as to how they're viewing the operations in Iran, day 4, day 5 into this conflict?
there are actually deeper divisions emerging between Europeans, how they look at that war. We have on the one side Spain, which is really becoming by now the one country, Pedro Sanchez, the Spanish leader, the one leader who's criticizing Trump the most, who does not want to spend 3.5% on defense, who denied the use of Spanish bases for that intervention. The Brits were also skeptical, but then changed their view. And then we have France and Germany, who really just try to say, well, we also didn't like the regime, and we will not pick a fight with Donald Trump over the fate of the Iranian regime. So at the moment, the Europeans are very much divided. And from a US side, the Europeans do not appear as particularly useful allies in this war.
What are some of the biggest fractures within the EU on this issue?
So there's on the one side the question of international law, right? I mean, the European Union and its members always pride themselves as being the one who uphold the rule of law, including international law. Then there is the risk of escalation. What if that really becomes a broader war? What if there is a new migration challenge coming from the war in Iran, especially for the southern member states like Spain, like Greece, like Italy, who have seen a lot of migrants coming from conflict regions in the Middle East in the last decade. And then, of course, there's a big question of how to handle Donald Trump. Is the right strategy a strategy of engagement or a strategy of standing up to Donald Trump? And views are increasingly changing on that, especially after the crisis over Greenland.
So that, I guess, goes to the broader issue, Liana, is just how are the countries in Europe, how are they viewing, I guess, the global world order? Is it, in fact, changing? Is it almost you can't rely on the U.S. or maybe rely on them less than you did in the past? It's more go it alone, if you will. Is that new world order, is that something that's being embraced by the European Union and member states?
Yeah, I mean, the nature of the European Union and its member states has been very different from the sort of era or the phase that we are living in now in global conflict. The European Union was built in cooperation, not integration, working with your allies, dialogue, diplomacy, and trade with your adversaries too. So the whole idea was very much of the European Union in its latest formation was very much an idea of the 90s. And now the European Union is changing. Now it has to use its free market tools, its trade tools to assert itself in a more volatile world. And it's certainly the speech of President Macron, who talked about a greater nuclear umbrella for his European neighbors, has been a very clear step that Europeans are looking beyond the United States, even and including on nuclear deterrence.
Are European governments preparing for any potential spillover risks from the recent escalations we've been seeing?
Yeah, so the European Union isn't particularly preparing for migration risks. I mean, I think that's the greatest concern, but also, of course, for Iran trying to retaliate in European countries by doing sabotage, terrorist attacks, using whatever networks they still or proxies that they have in Europe. That is certainly a concern right now. But most importantly, the biggest concern is how long will this war continue between the United States and Iran, and also how much further will it drive up energy prices at a time when Europe's energy prices were already much higher than energy prices in the United States?
Liana, about 30 seconds left here. What is the latest thinking from your part of the world as it relates to Ukraine?
Well, the problem with Iran is that it really crowds out any bandwidth that there is on Ukraine. That's why Friedrich Merz, the German chancellor, who was in Washington, D.C. yesterday, really tried to remind Donald Trump of that issue, saying, well, look, we need to make progress on Ukraine. The problem is that Vladimir Putin may look at this war in Iran, who has been supportive of Russia's war against Ukraine, who Vladimir Putin perceived, if not an ally, then at least a partner. Russia will not be amused by what is happening against Iran, and that might also decrease their appetite for constructive negotiations on Ukraine if they ever had that appetite.
All right, Liana, thank you so much. Appreciate getting your views. Liana Fix, Senior Europe Fellow at the Council on Foreign Relations.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.